I'm just making a quick low budget video of how I try to think about and pick options contracts. A couple of people have asked me how, and it's a little too hard to do over a text, so I figured I'd just make a quick video about it. So first I'll just cover the basics. Buying a call. So it gives you the right to buy the stock at the strike price of the contract at any point in time. If the strike price is, say, $125, you can buy 100 shares of that stock at $125 at any time during that options contract. Selling a call is just the opposite of buying a call. You have an obligation to deliver the security at a predetermined price to the option buyer. If they exercise the option at any point during the contract, you have to sell them the shares at the strike price of the option contract. Now we'll talk about puts. Buying a put, it gives you the right to sell a security at a predetermined price at any point during the contract. And selling a put is just the opposite. You have an obligation to buy the security at a predetermined price from the option buyer. If they exercise their right at any point during the contract, you have to sell them 100 shares at the strike price. I'm not going to talk about the Greeks in this video too much. There are plenty of YouTube videos and websites that go into great detail on it. Just understand that they're components of an options contract that affect how the price of the options contract changes based on the change in the underlying stock price. They're very dependent on how far away your strike price is away from the current stock price and how much time is left on your expiration of your contract. So one of the most important steps in picking an option contract is figuring out which stock you want to trade. I recommend buying option contracts on stocks that are trending upward on the daily chart or even the weekly chart. If I'm going to bet that a stock's going to go up, I want to bet with the long-term trend. It's never a good idea to buy a call on a stock that is in a downtrend. That would basically be taking a position on a company that is counter to what the market sentiment is. It's a little bit like trying to swim upstream, and it's just going to make making profits consistently a lot harder. For an example here, you can look at Boeing. You can see that the trend line on Boeing has been going up overall since mid-March. The price had dropped down to that green trend line 4 different times, and each time it has bounced off that line. The reason these trend lines work so well is because everyone can see them. When buyers are looking at the same chart, they all are waiting for the same price to hit that green line. And when it does, you get a flood of buyers coming in at the same time, and it drives the stock price up. You can also see that Boeing is at a horizontal support area at about $168. This is just another trend line where buyers are likely to come in and push the stock higher. The more different support areas that you can converge at the same time, the more likely it is the stock's going to go the direction you want it to. When buying an options contract, you're paying for time. It's not like just owning a stock. You can't just wait out the market. Every day that it either trades sideways or trades down costs you more money. You got to be a lot more precise whenever you're picking your buy prices on options contracts. So for this example, let's choose a strike price of $170 on Boeing. A $170 call contract for Boeing expiring next week costs $5.98. That means for me to make money, Boeing needs to go up to $175.98 before expiration. And that's just the break-even point. And that's also assuming that I hold the contract the whole time. But let's assume that I believe Boeing will be $185 at the end of next week. Does it make sense for me to buy this contract? For me to answer that question, I needed to see what the implied volatility for Boeing is for this contract. As you can see, for this contract, the implied volatility is 48.89%. Now to convert that into a number that actually helps me, I need to use the following formula. You take the stock price, you multiply it times the implied volatility, and you multiply that by the square root of the days left to expiration for the contract divided by 365. And this will give you the actual dollar value of the expected change in price of the stock during the options contract. So basically, how much movement in stock price are you paying for as part of this options contract? When I calculate it using the numbers shown on the screen, for this example, I get an expected stock price change of $7.72. That's what's priced into this options contract. You take the stock price for this example, which is $174, and add $7.72 to it, you get $181.72, which tells me I need to believe that Boeing will be above $181.72 before the end of the contract for it to make sense for me to actually buy this contract. And since I said from the previous slide that I believe Boeing has a chance to be 185 or higher by the end of the contract, then buying this contract would make sense because my expected stock price change is higher than what's been priced into the options contract. So basically, it's almost like I'm getting a discount, which means that I can actually profit from this options contract. So to summarize, you want to pick a stock to trade using technical analysis or some kind of news, whatever it is you think that's going to move the stock, and then decide what price you think the stock will likely be by a certain date. I'll give you an example. I personally think Workhorse will be above $30, $35 if they get the USPS deal that's going to be announced on October 1st. So I purchased a $25 strike price for October 15th at a cost of $2 per contract. That strike price and option premium give me a lot of safety margin in my prediction. I'll make money even if the stock only gets to around $27, $28. So you want to calculate the expected price change using implied volatility and make sure you think that the stock is actually going to move more than what is priced into the contract. So looking at Amazon for right now, a $3,350 call on Amazon will cost you $40.78. And that's expiring at the end of the week. So for this example, Amazon could go up for the rest of the week and finish out at $33.75, and you would lose all of your money. The only reason I bring this up is because it's not enough to think that a stock's going to go up or go down. It needs to go up more or go down more than what is actually priced into the options premium. You need to think Amazon's going to go up more than what's priced into that $40.78 price tag. So I've made this video to kind of summarize my general thinking when I am going through stocks and options contracts, trying to decide what I think could or could not be a good play. This is by no means a comprehensive options trading strategy. You can go on YouTube and watch 100 hours of video and you would still have another 10,000 hours of video to watch to understand everything there is about options contract. But this is just kind of a quick summary of what I look at when I'm trying to narrow down what I want to trade. I'm not an advisor. I am not in the financial industry. This is just my opinion and how I approach it. So if you find it useful, feel free to try it. If not, no harm done. Thanks.